This lecture is over risk and return, the capital asset pricing model, which you may also hear referred to as CAPM. I'm your professor, Dr. Stephen Haggard. Let's start with the simplest case, where we have a portfolio composed of two assets. In this graph, we show the risk and return for both SuperTech and Slowpoke. Recall from earlier that Slowpoke has an expected return of 10% with a standard deviation of return of around 10.5%, and SuperTech has an expected return of 15% and a standard deviation of returns of around 24.2%. Therefore, we can plot any asset on these axes with regard to its risk and return. The square, which you see somewhere between Slowpoke and SuperTech, is representative of the portfolio we constructed earlier, which was 60% SuperTech, 40% Slowpoke. If you'll notice, the expected return on that portfolio is 13%, and the standard deviation of returns is 14.93%, which is just as we calculated previously. It turns out that any combination of SuperTech and Slowpoke can be plotted along a line between SuperTech and Slowpoke. The line is represented by the curved portion you see at the top of this graph that goes from Slowpoke to point 1 to MV to point 2 to point 3 to SuperTech. The more SuperTech you would find in a portfolio, the closer it would be to the SuperTech point, and the more Slowpoke in the portfolio, the closer that portfolio would be to Slowpoke on this graph. Now, you may notice that this line doesn't go directly between SuperTech and Slowpoke. That's because there's less than perfect correlation between SuperTech and Slowpoke. If SuperTech and Slowpoke were perfectly correlated, there would be a direct line from Slowpoke to SuperTech. Okay, there are some interesting things to notice about this curve. First of all, MV stands for minimum variance. This is the least risky portfolio you can create out of SuperTech and Slowpoke. Knowing that MV is the minimum variance portfolio, would you be willing to invest in portfolio 1? The answer should be no, and here's why. It has greater risk than the minimum variance portfolio, but it has lower return. And we know that in an efficient market with sane, rational actors, people aren't going to invest in a portfolio like that. And so what we see is that even though portfolio 1 is in the feasible set or opportunity set, which includes the entire curved line between Slowpoke and SuperTech, it is not in the efficient set of portfolios. In fact, that efficient set only spans between MV and SuperTech, because all of the portfolios below MV on that curved line will have higher risk and lower return than the minimum variance portfolio. In the last slide, I mentioned that the reason the line between SuperTech and Slowpoke wasn't perfectly straight was because SuperTech and Slowpoke are less than perfectly correlated. And we have a demonstration here of what the change in correlation does to the shape of that curve. Notice that when the correlation is 1, we just have a straight line between the two stocks, just as we mentioned in the last slide. However, when that correlation starts to fall, there becomes a curve in the line. And the lower the correlation is, the more extreme that curve gets, until at the point of perfect negative correlation, we wind up with 0 risk and a positive expected return. Now, many students at this point say, wow, that's great. We should do that. The problem is it's very difficult to find two stocks with positive expected returns that have a perfect negative correlation. Now, I gave this lecture one time and a young man said, what about the S&P 500 index and the anti-S&P 500 index? And I told him I was unfamiliar and asked him to explain it to me. He says, well, the anti-S&P 500 index is designed to go down 1% every time the S&P 500 goes up 1%. Wouldn't they be perfectly negatively correlated? And in fact, they are. But the problem is that they also have the same expected return, only one is negative and the other is positive. If the expected return of the S&P 500 is 12%, then the expected return of the anti-S&P 500 would be negative 12%. And so we would have a problem of combining two stocks, with one with a positive expected return, the other with a negative expected return. And so between the two of those things, if you held a balanced portfolio of the two, you'd have no risk, but you'd also have no return. And we know that's suboptimal because if you are taking no risk, you should be receiving the risk-free rate. And so this would actually be a very bad investment to make. So, even though it would be lovely to find two stocks with positive expected returns and perfect negative correlation, you're not going to find it in the real world. However, you will find some stocks that are negatively correlated, and definitely you're going to find many stocks that are less than perfectly positively correlated. In fact, it's hard to find two stocks that are perfectly positively correlated. Take, for example, Royal Dutch Shell. It's actually two companies. It's a company that's traded out of the UK and a company that's traded out of the Netherlands. Now, the stock represents claims on the same assets, and so the movements of the stocks of these two firms should be perfectly positively correlated. But in reality, they are less than perfectly positively correlated. So even two stocks for the same company may not have the same returns. Okay, now the other thing I want you to see out of this graph is that the curvature represents diversification benefit. Notice that these curves all have greater return or less risk than the straight line beneath. And that's how the diversification benefit works, is that as the stocks become less and less correlated, you get rid of more and more risk without giving up return. What we've learned so far doesn't just apply to individual stocks. You can also apply it to country portfolios. For example, let's consider a portfolio composed of an index fund, perhaps the S&P 500, of U.S. stocks, and an index fund of large cap foreign stocks. And we see that United States stocks and foreign stocks are less than perfectly positively correlated. How can I tell that just from looking at the picture? It's because the line between the two is not perfectly straight. It has a curve to it. So we know these things are less than perfectly positively correlated. And though you may think that foreign stocks are riskier than U.S. stocks, and by looking at this chart we can tell that's definitely true. It looks like they have a standard deviation of returns of around 0.23 versus 0.17 for the U.S. We can see that by adding some foreign stock to our portfolio, we can actually reduce risk because the foreign stocks are less than perfectly positively correlated with U.S. stocks. Now, recall earlier that I said that the efficient set ran from the minimum variance portfolio out into where the high-risk asset is at. And I recall giving this lecture and telling students that sane, rational people would not be invested anywhere beneath the minimum variance portfolio. And it occurred to me as I was talking that my portfolio was 100% US. And I had two choices. I could either continue to be invested 100% US and no longer to consider myself a sane, rational individual, or I needed to diversify my portfolio into foreign stocks so I would be somewhere on that efficient set. And being a risk-averse professor type, I chose to put myself at the minimum variance portfolio. So right now, all my retirement is invested 80% US, 20% foreign. So now at least I am on the efficient set. So far we've only talked about portfolios combining two assets or two funds. But in fact, we can extend this to many assets. And what happens is that we no longer wind up with just a line, we wind up with an entire area of possible portfolios. In this picture, that area is represented by the blue shape there. Now sometimes people see those little scallop batwing things and think that that is where the area ends. It's not. It just keeps going and going, so don't worry about that. Now notice that the outer edge of this thing looks much like what we saw with the two assets. There is a curve that we would call the feasible, well, this is all feasible set. This entire blue area is feasible set. But we've got this frontier. But only the portion between MV and X is considered efficient. And we call that the efficient frontier. Remember, frontier only means edge of something. Okay, so why is MV to X, that nasty green line, the efficient frontier? Well, the answer is any of the portfolios that are down there in blue are suboptimal. For instance, would you want to buy portfolio W? You shouldn't, because if you moved up to portfolio R, you would be getting more return for the same amount of risk. Would you want portfolio 1? Absolutely not. You could either go straight up to the green line and get a portfolio with greater return for the same amount of risk, or you could go straight left over to the green line and get a portfolio with the same amount of return but much less risk. And so none of portfolios W1, 2, or 3 are optimal. The only optimal portfolios along this in this area are along that green line, and that's called the efficient frontier. Now, we haven't discussed what pushes people along this efficient frontier. It's risk aversion. As you are more tolerant of risk, you're willing to invest further and further out toward X. But something you need to notice here. When you first move away from MV and take on one additional unit of risk, you get a lot of extra return for that. But when you get out toward X, each additional unit of risk gets you only a little more reward. And so the rewards are increasing in risk, but at a decreasing rate. So far, we've only allowed investors to invest in risky assets. That entire blue field is composed of portfolios of risky assets. Something amazing, though, happens when we are able to also invest in the risk-free asset. Remember, for our purposes, we consider the 3-month T-bill from the United States government to be the risk-free asset. And if you invest in that risk-free asset, you're going to have a standard deviation of 0 because there is no risk, but you will receive the return on the 3-month T-bill, which we refer to as the risk-free rate. And so that puts you over on the left-hand side of this graph, over where it says risk-free rate. Now we can actually combine the risk-free asset and risky assets in our portfolio to get different compositions of risk and return. And we could actually think about hinging that the green line, hinge it over there at the risk-free rate. And what we're going to do is we're going to start cranking that line counterclockwise until it is tangent to the efficient frontier. Now what does tangent mean? It means touching at only one point. And why are we doing that? Well, we want to crank that line counterclockwise because that increases the slope. And the slope here represents return per unit of risk. We would like to get absolutely the most return per unit of risk that we possibly can. And so when we crank that line around, the maximum slope it achieves is when it is perfectly tangent to that field of risky assets. Now, there's something very special about the place where it touches. We refer to it as the market portfolio. And in theory, it contains every single risky asset known to man held in weight according to its importance in the economy. For instance, the shares of Apple would be more highly represented in that market portfolio than the shares of Leggett & Platt, which is a Fortune 500 company out of Carthage, Missouri. Why is Apple more heavily weighted? Because it's more important in the economy. If you think about Apple's market capitalization, it's many, many, many times that of Leggett & Platt, and so it makes sense that there would be more of it contained in this market portfolio. Now, often we think of stocks being the only risky assets, but it's not true. Bonds aren't as risky as stocks, but they are still risky assets. Also, think about real estate. If you don't believe that real estate is a risky asset, ask someone who's had to sell a house recently at a loss. My wife and I personally lost $39,000 on the sale of our last home because of price volatility in the real estate market. So houses are risky assets too. And so houses should be represented in that market portfolio. The question is, can you invest proportionally in my house? And the answer is no. And so even though theoretically we know what this market portfolio should be, it's really difficult for us to construct a perfect replica of it. And so often what we settle for is using the S&P 500 as our proxy or stand-in for this market portfolio. Now, another benefit of investing in both the risk-free asset and this single portfolio, the market portfolio, is that we can perfectly choose along that line how much risk we want to take, and we get rewarded in the same proportions for the risk we take on. In other words, the slope of that line is exactly the same over near the risk-free rate as it is out toward portfolio 5. Remember when we were investing purely along the efficient set, that as we moved up that curve, we got less and less reward for taking on the same amount of additional risk. So that's a major enhancement over the previous slide. Now, you may understand perfectly how we could invest between the risk-free rate and A. We could have 40% risk-free asset, 60% A, and so on. But how could we be investing out at portfolio 5? It's not between the risk-free rate and A. And the answer is borrowing. Remember that the portfolio weights just have to add to 1. In other words, 100%. When we're just doing buying bonds or T-bills and the market portfolio, it's easy to think of 20 and 80, 60 and 40, 70 and 30. Those things all add to 100%. What's harder for people to think about is that you could actually invest your portfolio 150% in the market portfolio as long as you were willing to borrow 50%, because that would be a portfolio weight of minus 0.5. And 1.5 plus minus 0.5 is 1.0. So we haven't violated the requirement that our portfolio weights add up to 1. Now, what kind of person would be investing in portfolio 5? They would have to be extraordinarily low on risk aversion. We're talking about the kind of people that jump out of airplanes with parachutes. Well, that would actually be more risk averse than those who jumped out without, but I doubt they would live to invest their money. So, what do we see in the real world with people? Typically, most people are invested somewhere between the risk-free rate and A. You'll only occasionally see people invested out at portfolio 5, and they are doing so by buying on margin, which is where they borrow money from their broker to buy stocks on credit. It's extraordinarily risky, and I don't advise it. And what you'll see in your own life is as you get older, you will become more and more risk averse. which means you should be investing closer and closer over to the left-hand side on that green line. Oh, by the way, that line has a name. It's called the capital market line. That's the line that extends from the risk-free asset through the market portfolio and beyond. That's called the capital market line, which you may see abbreviated as CML. Notice that every portfolio along the capital market line has higher reward for the same amount of risk or lower risk for the same amount of reward as any other portfolio shown in the blue area. In other words, the highest amount of reward for the same amount of risk comes from investing along the capital market line. And so sane investors will be investing along the capital market line. Now, another thing that you need to notice here is that all investors should be invested only in the risk-free asset and in the market portfolio. And the only thing that differs between risk-averse and non-risk-averse investors are the proportions. Risk-averse investors will have primarily risk-free asset with very little risky asset, otherwise known as market portfolio. And your less risk-averse investors will have more of the market portfolio in their portfolio and less of the risk-free asset. This is known as the separation principle. Now we're going to find out what makes stock prices go up and down, and the short answer is news. Investors and traders bid stock prices up and down based on the arrival of news. However, not all news will move stock prices. Even news about the firm may not move the stock price because the news might be expected. So it's only the unexpected portion of news that moves stock prices because the expected portion is already priced in. Let's do an example here. If a company announces earnings per share of $1.04 and the market expected $1, only the 4-cent surprise moves the stock price. The market already had priced in the expected $1 announcement of earnings. Now, the unexpected portions are expected to average 0. Why? If they didn't average 0, they would be added to the expected earnings. There are two types of risk that we need to be concerned about: systematic risks and unsystematic risks. What are systematic risks? Well, these are risks that influence a large number of assets, also called market risks. For example, the earthquake in Japan affected a large number of companies, all the way from Apple to General Motors, anybody whose supply chain went through Japan. Also, if you were in the nuclear power business, that earthquake was a systematic risk because it forced a reassessment of our dependence on nuclear power. So that's very definitely a systematic risk. Then we have unsystematic risks. These are risks that affect a single asset or a small group of assets, also called unique or asset-specific risks. For instance, the death of a popular CEO, for instance, Steve Jobs, that's an unsystematic risk. It really affects Apple. Did it cause problems at HP or at IBM? No. So it's an unsystematic risk. Now, you might say that there are lots of people who depend on making applications and accessories for the iPhone, and that you might be able to argue then that Steve Jobs' death was a systematic risk. Let's do a better example then of unsystematic risk. The president of a local beer distributorship dies in a tragic plane crash. While it's tragic and sad, it would not be a systematic risk because it would really only affect the one firm. Now, what's the difference between unsystematic and systematic risk from an investor's perspective? Well, unsystematic risks can be diversified away. If the assets are not all moving in the same direction, if assets are moving in different directions as they would be with unsystematic risk, then by holding many assets, you can get rid of that risk. But systematic risk, ones that affect every asset or many assets, cannot be diversified away. Now we're going to look at what adding additional stocks to your portfolio does to the total risk of the portfolio. What we have over here in the left-hand column are the number of stocks in the portfolio. In the second column is the average standard deviation of annual portfolio returns, and in the third column is the ratio of the portfolio standard deviation to the deviation of a single stock. So, how did this experiment get done? Well, the authors over and over randomly chose one stock for that first line. They chose one stock. And of all the stocks that they chose, the average standard deviation of the portfolio of the returns for that stock were 49.24%. And so that's where that number came from. And of course, the ratio of 49.24 to 49.24 is 1.0. Now, the next thing they did was randomly chose two stocks from the pool of available stocks and put them in a portfolio together and saw what the standard deviation of that portfolio would be. On average, those randomly drawn portfolios of two stocks had a standard deviation of 37.36%, which we can see is 76% the standard deviation of the single stock. So we were able to dump 24% of the risk by simply adding a second stock. That's pretty amazing. Now we're going to double again the number of stocks in the portfolio. This time the authors chose out 4 stocks at a time and looked at the standard deviation of returns for a portfolio composed of those 4 stocks. And the average for those portfolios of 4 stocks was 29.69%, which is 60% the risk of a single stock portfolio. Now I want you to notice a couple of things here. First of all, we doubled again. But did the risk drop another 24%? No. This time we dropped from 76% down to 60%. And so this is the first thing we need to know about diversification, is that increasing numbers of assets reduces our risk but at a decreasing rate. In other words, we're going to see this thing kind of trail off and become asymptotal, which means it's going to become closer and closer to a value but not quite touch it. And so we'll see that here in a minute. But you can see as we go along and add more and more stocks that this ratio, portfolio standard deviation to standard deviation of a single stock, gets lower and lower until we get down to 200 stocks. And then we're basically stuck in the neighborhood of 39%. Notice that whether you've got 200, 300, 400, 500, or 1,000, we're still stuck in this neighborhood of 39% of the standard deviation of a single stock. And so additional stocks help out diversification-wise, but it helps more when you're going from 1 stock to 2 stocks than when you're going from 500 stocks to 501 stocks. Also notice that there's a portion of risk that we just can't get rid of. If you haven't guessed it already, what we've been getting rid of was the unsystematic risk. That's the risk we said we could diversify away. What's left? It'll have to be systematic risk, which we also call undiversifiable risk. Here's the same idea, but in a graphical format for you visual learners. Notice that the first stock, down here, number of stocks and portfolios on the horizontal axis, and we have 49.2% standard deviation. And as we add stocks, that standard deviation comes down until it gets really close to 19.2%. But it doesn't drop below that 19.2%. Thus, 19.2% must be our level of non-diversifiable or systematic risk. That's the blue part. That's risk you just can't get rid of. But that tan greenish part is the diversifiable risk. That's part that we can get rid of by adding additional non-perfectly correlated assets to our portfolio. So far, the measure of risk that we have talked about has been return standard deviation. This is a measure of total risk, and we also call that volatility. But we've been learning that there are really 2 kinds of risk. There's systematic risk and there's unsystematic risk. So we need to come up with a measure for systematic risk. Now the market is only concerned with systematic risk. Why is that? Well, think about this. If you've got a bunch of people out there bidding on assets, People with well-diversified portfolios will only be bearing the systematic risk. Therefore, that's the only risk they will demand to be compensated for. And because they have lower required rates of return, they'll be able to offer higher amounts of money for the same cash flows going forward. Remember, the price of or value of anything is the present value of the future cash flows discounted at a rate appropriate to the systematic risk. As a result, in every bidding war for an asset, the people with the diversified portfolios will always win. And as a result, they're the ones that set asset prices. That's why the market really only cares about systematic risk. Well, now that we know that we must come up with some sort of measure, some way to measure this systematic risk. And that measure is called beta. The easiest way to think of beta is to think of it as the slope of the characteristic line. What's the characteristic line? Well, it's a plot of the returns on a security versus the return on the market. And the greater the slope is of that line, the greater the systematic risk is of the security. In this example, slope, or beta, is equal to 1.5. For those of you who don't recall your mathematics training, slope is rise over run. That means for every 1% increase in the return on the market, the return on this stock must increase by 1.5%, so 50% more. So we could say roughly that this stock is 50% more risky than the market. Here we have betas for several different stocks. And we've got them organized in order of ascending beta, which means that these get riskier from a systematic perspective as we go down the list. The first one is American Electric Power at 0.32. Remember that the beta for the overall market is 1, so American Electric Power is much less risky than the overall market. Why might that be? Well, keep in mind that we are talking about how the market reacts to the economy and how the individual stock then reacts to the market. During an economic recession, production at factories goes down, so less electricity is consumed. But that's only a small portion of electrical consumption. Most consumption is household consumption. Do people's refrigerators run any less during a recession? Probably not. And they usually don't turn their lights off any more during a recession than during regular times. And so we wind up with a situation where the fortunes of American Electric Power are not as tightly tied to the economy as other companies. And so it has a low beta. Johnson & Johnson is a healthcare company. Similarly, people do not consume that much less healthcare during bad economic times, nor do they consume that much more during good economic times. And so the beta of Johnson & Johnson is also less than the overall market. And then we have Tyson Foods. The primary product of Tyson Foods is chicken. Chicken is cheap protein. It only takes about 4 pounds of feed to put 1 pound of meat on a chicken, whereas it takes 10 pounds of feed to put 1 pound of meat on a cow. So chicken, therefore, is cheaper. People hardly ever say, "Wow, things are great at work. I just got a raise. Let's go out for chicken." They say, "Let's go out for steak." And so Tyson Foods, it's not surprising, has a beta of less than 1 because it is not tied as tightly to the economy as a more luxurious good like beef. Next we have Allstate Insurance. Allstate is getting closer to being as risky as the overall market, but it's still not quite there. Allstate provides insurance in many different states for many different things. It makes sense that Allstate is no more risky than the overall economy. 3M is a diversified industrial company, and they provide products across a range of many different things. And so they are basically a diversified portfolio of different things that might have different exposures to the economy. Overall, though, the beta of their portfolio of divisions is 1.04. Then we have Hewlett-Packard. Hewlett-Packard provides printers and computers. And you can see that their beta is higher. During good economic times, people would come near replacing a computer or printer. During bad economic times, people will stick with their old one. And so what we see is that Hewlett-Packard is actually riskier than the overall market. Dell's beta is similar because their business lines are similar. Finally, we have AIG, or American International Group. This is a big insurance company that nearly went broke during the financial crisis. And I am not sure that this beta of 1.81 will be a long-term beta for AIG. Over the longer term, I would expect AIG's beta to return to something similar to what we see for Allstate above. You're probably wondering how to calculate beta for a portfolio. Well, unlike total risk, which is standard deviation for individual stocks, the systematic risk, or beta, is not reduced by the presence of non-perfectly correlated stocks. Remember, beta represents systematic risk, which is not diversifiable. Therefore, the beta of a portfolio is just the weighted average of the betas of the components of the portfolio, just like for return. So the beta of the portfolio is equal to the weight of component A times the beta of component A, plus the weight of component B times the beta of component B, and so forth until you cover all the components of the portfolio. Now that we know the measure of systematic risk is beta, we should be able to come up with some way to figure out what the required return on a security should be based on its beta. And that's what the security market line is all about. Now, the security market line comes from a theory called the capital asset pricing model. And so sometimes you may also hear this referred to as CAPM. But it's all the same thing, and you don't need to worry about them being two different things. Okay, so what do we have here? We have a vertical axis that says expected return on the security, and then we have a horizontal axis that says beta of the security. And we know that beta is a measure of how something performs versus the market. If something goes up 2% when the market's up 1% and goes down 2% when the market's down 1%, then that stock would have a beta of 2. So what does that mean the beta on the market itself is? Well, it has to be 1, because the market goes up by 1% when the market goes up by 1%. So by definition, the beta of the market must be 1. Now, what is the expected return on the market supposed to be? Well, if you look over, by the way, that M on the line stands for market. So down below M, we can see that the beta is 1, and over to the left, we have the expected return on the market. And then on the horizontal axis, we know that if there's no risk whatsoever, you can get the risk-free rate. And so now we have 2 points on a line. Now, if you remember your high school algebra, you can figure out the equation of a line given any 2 points on it using something called slope-intercept form. And that's exactly what we do with this security market line. Now, our previous picture of the security market line is all well and good, but we need to be able to put this into an equation form so you can work problems on exams. And so what we have here is the expected return on security I, in other words, a stock, is equal to the risk-free rate plus beta sub I, that's the beta on stock I, multiplied by, and then we have the square brackets, and inside the square brackets are expected return on the market minus the risk-free rate. Now let's talk about the individual pieces here. The expected return on the market is what we think the market is going to return in the coming year. The risk-free rate, you might see a problem that says the interest rate on treasury bills or the yield on treasury bills is such and such. That's your risk-free rate. And that piece in the square brackets is called the market risk premium. Now, a lot of people get screwed up and they'll see a problem that says the market risk premium is, and they'll take that number and they'll subtract the risk-free rate. That's wrong because you basically subtracted the risk-free rate twice. And so if the problem says the expected return on the market is, then you subtract the risk-free rate before multiplying by beta. However, if the problem says market risk premium is, then all you have to do is multiply that by beta. And once we multiply by beta, what do we get? Well, that's the risk premium on security I. How do I know that? Remember, any return over and above the risk-free rate is the risk premium. Well, everything here above the risk-free rate is that piece over on the right-hand side beyond the plus sign. So it must be the risk premium for the security. Okay, so we need to figure out how to calculate beta. And one common way that we do this is through something called linear regression, which I hope you're familiar with from your statistics class. And so what we need in order to be able to do this linear regression is we need returns for the market and we need returns for the stock in question. And so what I've got here is some data. The columns that say GE and SPY were downloaded from Yahoo Finance. You can download historical data. And so GE, that's just General Electric, so that's the share price for every day in 2007 and the last day in 2006. Now, why the last day in 2006? You need that in order to be able to figure out the first return of the year. And I've done the same thing for SPY. Now, what is SPY? Well, it is an exchange-traded fund that is designed to mimic the S&P 500. And the S&P 500, we said, was a proxy for the market portfolio. And so we're using a proxy for a proxy here. And that's going to be our market return. I also have RF, which is the risk-free rate. And I got that from the St. Louis Federal Reserve's website. Okay, now the next step, of course, is to figure the return for each of these stock prices. And so, if I click on the cell here, you'll see that all I've done is taken today's price minus yesterday's price and divide by yesterday's price. And I do the same thing over here for the S&P 500. That's how we get our return. So that's pretty simple. Let's see. Now, think about that security market line equation. It says the expected return on the security is equal to the risk-free rate plus beta times the market risk premium. And so I'm going to make one little change. I'm going to subtract the risk-free rate from both sides. So on the left-hand side, I'm going to have the expected return on the security minus the risk-free rate, which is also known as the market risk premium it's the risk premium for the security. And over on the right-hand side, that just leaves us with beta multiplied by the expected return on the market minus the risk-free rate, which is the market risk premium. Okay. Now, by doing that, we get rid of our y-intercept. Risk-free rate was our y-intercept. And so when we do this regression, the intercept should be 0 or really, really close to it. Now, linear regression, if you've ever done it by hand, is extraordinarily painful. And so we're going to go about this a different way. We're going to let Excel do the work for us. Now, Excel comes out of the box like this. If you go to the Data tab, you'll see there's nothing up here about regression or anything like that. And so what we need to do is load an add-in so that your Excel can do this. And here's how we do that. Go to File, then we go to Options, and we will go to Add-ins. Now don't be fooled, it won't work to click on stuff up here. You have to go down here where it says Manage Excel Add-ins, and I hit Go. And now you want to click Analysis Tool Pack. VBA is a programming language. I don't know what difference it makes. So I'm just going to click Analysis Tool Pack and hit OK. Now notice now that we have Data Analysis up here on our toolbar. I'm just going to go ahead and click that. And I'm going to go through here. There's all sorts of neat stuff that you can play with. Correlation, covariance. But we're going to do regression and hit OK. Now I want to put in the Y range. Remember, Y is expected return on the security minus the risk-free rate. And so all I'm going to do is select all these returns for GE. And when I'm done, it automatically puts them in there. Now I've got to click into the input X range, and I'm going to do all the returns for the S&P 500 minus the risk-free rate, so really the risk premium. And I'm going to do it to a new worksheet. That's fine. I'm going to hit OK. Now, this is a little small, so I'm going to make it bigger for you. First thing you do is go through here and widen these columns out, because for some reason this thing comes out compacted and it's really hard to read these long numbers. And so we'll just go ahead and do that. Okay, so now let's take a look at our numbers here. First of all, R squared is basically it's a measure of how well one piece of data explains another. In this case, how well does the market return explain GE's return? And the R squared here is 0.60. That means that 60% of the variance in General Electric can be explained by the variance in the market. Well, that's pretty good. Now in engineering we would have made fun of an R squared this low. We always wanted 0.95 or 0.96. But in social sciences, which finance is a social science, we end up with much lower R squareds. In fact, I have papers published with R squares below 10%, and they're in good journals too. So this is actually really great for finance type regression. Okay, now we're going to go down here and we've got intercept. So this is the y-intercept, but we said there wasn't going to be a y-intercept, so this thing should be really close to 0, and it is. Now first of all, don't be freaked out by the E05. It's E minus 05. All that means is the number in front of that multiplied by 10 to the negative 5th power. And so all we do is move the decimal point over by the number of by that number of the exponent. And so we wind up with minus 0.00007 and some change. In other words, really close to 0. So that's exactly what we wanted. And we can see over here t-stat, hopefully you remember from statistics, a t-stat that low is not significant. This thing's not significantly different from 0. Now, the other thing that we're interested in is the slope on x variable 1. That coefficient is beta. And for GE, it's showing to be around 0.894. And that matches up really well with some of the historical betas for GE that are given in your textbook. And so we've really done some good work here. It didn't take that much effort, and hopefully in the future you will know how to use Excel for linear regression.